I'm a very flexible person. I don't change my mind, but I'm flexible. And you have to be. You just can't have a wall and you'll only go. No, sometimes you have to go around it, under it, or above it. I helped Tim Cook recently and that whole business. I don't want to hurt anybody, but the end result is we're going to get to the position of greatness for our country.
President Trump saying he is flexible, but investors are getting bent out of shape, trying to keep up with his changing tariff stances. Live from Singapore, this is Inside with me, Haslinda Amin, where we dive deeper into the latest tariff headlines with crucial context and sharp analysis. Japanese stocks lead gains in Asia as Trump foreshadows a potential pause in auto tariffs, but U.S. futures flashing a caution signal as he pushes forward with plans for levies on chips and medicines. Treasury Secretary Scott Bessent plays down sell-offs in the dollar and bonds, telling us exclusively he does not see systematic dumping of U.S. debt.
I have no evidence that it's sovereign. We are still a global reserve currency, that we have a strong dollar policy. The dollar can go up and down.
We'll get insight on trading the trade war with Deutsche Bank's global CIO Christian Nolting, who sees sold-off stocks as a buying opportunity. Find out where he's looking in just a moment. Plus, we check the mood in crypto markets with the biggest exchange in the U.S. Coinbase Global Institutional Sales Head Lauren Abendschein will be joining us exclusively this hour. Well, let's take a look at how Let's get to markets. Asia stocks tracking U.S. gains as a degree of calm returns to Wall Street, with Trump offering some reprieve for car makers. Treasuries, meanwhile, extending their rebound from a 5-day sell-off, yet some investors still see a higher risk of recession, either from tariffs or the current policy uncertainty. Avril Hong has been tracking the market moves. Avril, you got to wonder how much has been priced in when you look at these levels.
Yeah, I think a lot of it has been, and you're seeing a bit of cautious optimism creeping into whether Asia stocks or U.S. futures, even bonds, whether you're talking treasuries or APEC. It's a bit mixed still in currencies, and all this amid those lingering concerns, right? After a 5-day losing streak for treasuries and those concerns that they would ultimately push up the cost of all sorts of loans and deal another blow to the U.S. economy. So that is the perspective we're coming into this sort of rebound on Tuesday with. And keep in mind, the takeaway is still, I think, that there's no clarity on what the end game for Trump is when it comes to tariffs. Higher odds of recession potentially, as you flag, whether it's from tariffs or the policy uncertainty. And keep in mind, when it comes to treasuries, given how they had risen so far and so fast, some maybe saw it as a sort of buy opportunity. Now, one sector of the market that we are not really seeing partaking in that rebound as enthusiastically is Japan long-end bonds. You're seeing the 20-year still around the 242 level. Flip the board. They have been dealing with, on one end of things, the potential for additional fiscal budget from the government in order to deal with tariffs. And then on top of that, the BOJ sounds like it could also be putting on pause its fight against inflation. You think to Ueda talking just a day ago and seemed to be trying to erase any bets of a rate hike at the next meeting. And this chart shows you what the outcome of all that is for bond traders. You're seeing how they don't like this. It's meant a really sharp curve steepening, what MLive's Mark Cranfield calls a toxic mix that these bond markets are dealing with, Haas.
That's right. Not something bond vigilantes want to see. Avril Hong, thank you. Now, U.S. Treasury Secretary Scott Bessent has rejected speculation that foreign nations are dumping their U.S. Treasury holdings. He told Bloomberg exclusively he saw increasing foreign demand at recent auctions.
I don't think there's a dumping, and I think we saw in the tick data either today or Friday that actually foreign ownerships picked up.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence that it's sovereign.
Bessent adds his department has tools to address the dislocation if needed. He also downplayed concerns about the dollar's status as a global reserve currency.
We are still a global reserve currency, that we have a strong dollar policy. The dollar can go up and down. If you go and look back at President Trump's first term, I don't remember the exact number, but the dollar in 2017 went down, I can't remember, 7, 8, 9%, and then once the tax bill was done, took off for the remainder of his term.
Have you spoken to the Fed at all about contingency plans, though, if financial stability risks flare up?
Chair Powell and I have breakfast every week, and we discuss a wide range of things. And our staffs are always in contact. We have a markets room; they have a markets room. But and specifically, did we discuss some kind of a break the glass? I think we're a long way from that.
So when was the last time you guys spoke? You had breakfast last week?
We had breakfast last week, and it was an away game. I was over at the Fed.
And no concern so far from the Fed chair on what he saw in the Treasury market?
I think we would have heard from the Fed chair. I think we heard from Governor Collins of Boston on Friday. We heard from Governor Weller today on his thoughts on what tariffs mean. So it seems like business as usual. When
it comes to the Fed chair, his term is up May 2026. So we're almost 12 months out from that. When are you going to start to think about, have these discussions with the president about who should lead the Fed? Well, we think about it all the time. I think when are we going to start the interviewing candidates? And that'll be sometime in the fall. In the fall, so about 6 months lead time. Yep. The U.S. Supreme Court recently came out with a ruling that the executive branch, the president for now, could oust top officials at independent agencies. And that has some individuals in the market a little bit concerned about what this could mean for the independence of the Fed, which is really a cherished pillar of wanting to invest in America. Do you have any concern about potentially President Trump ousting Fed Chair Jay Powell or the independence of the Fed? Well, and Marie, I've repeatedly said the Fed has two duties, and I believe that monetary policy is a jewel box that's got to be preserved, and then they have regulatory policies, and I think we can have more of a discussion because the Fed is one among three bank regulators. There's the Fed, controller of the currency, and the FDIC. So I think it's very easy to delineate between those two. So at the moment, no concern? No concern. When you talk to Fed Chair Jay Powell, at the moment it doesn't sound like they feel like the need to step in on this unraveling we saw last week with the bond market. Does the Treasury have any plans to do something if this was to become more unnerving? Well, look, the Treasury has lots of things we can do, and but again, I think we're a long way from that. But all options would be on the table? Sure. But again, we have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted.
We'll have more from our exclusive interview with the U.S. Treasury Secretary later this hour. For now, let's get more market insights with Christian Nolting, Global CIO of Deutsche Bank. Christian, good to have you with us. We're seeing some stability in treasuries today after a 5-day sell-off, but some say expect more vol going forward, especially on the back of what we saw just last week, how yields surged the most in more than 20 years.
Yeah, I agree. So I think to say that's it and volatility is gone, I think that's quite unlikely to happen. So now we have this 90-day period of discussions about the tariffs. I think within there will be volatility. I'm not sure after 90 days all discussion is over. So I do expect further volatility, both on the bond side and in the equity side as well.
Are you of the camp that the Treasuries market is broken or not?
No, I don't think it's broken at all, but we have seen that moves in tariffs, right? And I think Scott Bessent has said he looks at the bond market probably a bit more than the equity market. And we have seen now the change in tariffs, so the 90-day period came up and now some easing as well, whenever the Treasury was moving quite substantially. I think U.S. is watching the treasury market very carefully, and if volatility is too high, they try to do something. And do expect this pattern to continue, to be very honest.
The thing is, even if treasuries are not broken, are they still a good hedge? I mean, given movements both up and down, and we're talking about massive movements, can you really now still rely on treasuries?
Yeah, I think you can still rely on treasuries. You can still rely on the U.S. economy. But of course, growth is coming down from our point of view. And what we take into account a little bit is also the uncertainty. I think growth is coming down because of the tariffs, and we don't expect tariffs to completely go away. I think there will be a higher level even after this 90-day period. And I think this uncertainty also takes some parts away from growth as well. So the earlier we get more certainty what the tariffs really are, I think the earlier it's possible for companies to plan what they want to do. Do they really want to go to the U.S.? Do they want to sell from outside? Does it make sense? I think as long as you know the tariff, the level, I think then it's easier to plan. Uncertainty then will take some growth away. And of course, this will weigh on the Treasury side as well.
So as you await for more clarity, what are you doing? Have you made any changes in your portfolio? What are you looking at?
Yeah, we have reduced U.S. equities a little bit ahead of the tariffs because we were a bit concerned it could be a higher going-in position to negotiate. But we have also told clients, don't panic. We have said when last week we had this massive downside, so in Europe equities were opening Monday last week more than 10% down. I think it's always wrong to panic. I think that's what we advise clients on. And eventually on equities last week, it was a positive week. So the question was, is the US looking at markets? I think they do. Now they have repeatedly doing this. And I think that's why to stay calm makes sense for our clients, for investors as well. But I would expect, again, as I said, more volatility to come. So I think now the market is probably, if you look at equities, in a range-bound situation. We have seen some move upwards, massive move upwards with the 90-day period, of course. And now there's still, I think, some volatility to come. And that's something clients need to take into account very, very, let's say, deeply.
Volatility is a gimme at this point. I'm just wondering if you think the S&P has bottomed, and do you buy the dip on the back of that?
Yeah, we've said we buy the dip in the market if it's closer to recessionary levels. And I think the top, if you look, was mid of February, 6,100 in the S&P. So I think whenever you see or have seen levels below 5,000, 4,800, we think that's rather a buying opportunity. And we have not changed our view on this one. So I do expect more volatility, but whenever we go closer to recessionary levels, I think it's a buying opportunity. Let's not forget, I think there's still a lot of potential growth rate in the US, and that's something which is still interesting for investors from our point of view.
How are you looking at the US dollar? It is pretty stable at this point in time after 5 days of losses, and some say expect dollar weakness to resume.
I couldn't rule that out, right? I think it's also a function of the central banks answering. So if you look, for example, does the ECB cut this week? There's a meeting this Thursday. The market is expecting a cut. I would go with that. And I think then it's, of course, the rhetoric. I think from a currency point of view, it's not in the interest of the US to have a super weak currency, because with that you would import inflation as well. And I think that's not in the interest of the US. On the other hand, again, let me use Europe as an example. You don't want to have an ultra-strong currency, I would say. So that's why I would expect them also to lower rates. So I think it's probably in a balance. But if you don't see a lot of central bank action, then I think the trend for the time being could be a weaker dollar. But I do expect something coming from other central banks as well.
Europe doesn't want an ultra-strong euro. Japan doesn't want an ultra-strong yen either. In terms of the currency market, currency space, which are the best crosses to be looking at?
Well, I think it's quite interesting to look at some Scandinavian currencies from that perspective, energy-backed. So I think that's quite interesting also from diversification. But let's also look, maybe it's not the direct currency, but some call it like look at gold as well. I think that's quite interesting what we've been seeing there. Quite some move, and I think people diversify currencies even more. So we are still bullish on the gold side, even after we had quite a run. I wouldn't say there are not any setbacks possible, but I think that's quite interesting to look at that space as well. And I think it's not the ideal hedge all the time, but I think gold has done quite nicely in this environment. And if you are in an environment where inflation is higher, and not ultra high, but higher 2 to 4%, I think gold has done pretty well. So we still like that as well.
How much of gold are you having in your portfolio? Have you been accumulating gold? Because it does seem like that's the preferred haven for a lot of investors.
Yeah, we have done this before, so last year already, so we have not increased this recently, but it's 2 to 5% depending on the risk profile of the client. And that's a position we keep having. And of course, we're having nice gains on this. We are not selling this right now, but I think that's well positioned. And we do expect some further gains on this one, because I think if you look, as I said, on diversifying currencies, that's also something people really take into account. And I would honestly use any setbacks in gold to add to that position.
And of course, investors have been buying the yen as a haven. We've heard from the BOJ saying that, you're unlikely to see a rate hike in April. I'm just wondering how it might play out for the yen, given what we're seeing in the long end of the JGBs as well. It has had a pretty torrid time of late on the back of those expectations.
Yeah, I think the strengths we have been seeing in recent days, I think that's not continuing from my point of view. So probably we'll see that calming down a little bit as well. And maybe there's some central bank action on this. I wouldn't be surprised to see that happening. So from that perspective, that was indeed quite some movement from that perspective. But I don't think it's continuing like this. So I do expect some answer from Japan on this one.
Okay, so that's Japan. Let's take a look at China, because the yuan has been well supported. Today, well supported because the fix was actually stronger than anticipated. But we've seen weakness in the currency. Some say that weakness hasn't yet reflected the weakness in the economy. How are you squaring all of that?
Yeah, I think on the renminbi, I would say I would expect that to weaken, or that China lets this weaken slightly, not massively though. I think that's not the experience they want to have, say, again. But I wouldn't be surprised if the currency is weakening a bit from here. I think that's quite intended. So from that point of view, that could reflect a little bit some weakness in the economy. But I don't think a massive move will happen from that perspective. But some weakness, I think, could well be the case.
But what's fair value for the currency, given the weakness in the economy?
Yeah, I think if you look forward, right, so if you have some weakness, that could help, of course, on the export side. I would say it's not about only the currency, it's about also some fiscal policy I would expect from China to support the economy. And by the way, Haslinda, let me say, even globally, I think those countries, those areas, those regions which would do fiscal policy is something we prefer in the market as well. It's not only China, it's also look at Europe, for example, some fiscal policy is happening. So I'm obviously from Germany, so there's more to come now once the government is founded. That should be the case beginning of May. So I think these countries have some firepower, if I may call it like this, to support. And I think that's where markets are quite interesting. And that's where we say maybe that's where to invest as well. So not only if you see kind of recessionary levels in the US, but those countries who can spend on the fiscal side, I think that's quite interesting as a reaction function.
Christian, has there been a fundamental change in the way investors are looking at Chinese assets, in particular Chinese stocks? Because we have a report on the Bloomberg today saying how, billions of dollars are making an exit from China ETFs. So there seems to be a turnaround in sentiment when not too long ago, China did become a darling for some time. In fact, some say luring investments from India into China.
Yeah, I think what we have been seeing, we have seen outflows of ETFs in equities, I would say, globally, right? So I would say I don't see that massive change towards China. I think there's rather the idea that there is fiscal spending coming, that there is monetary policy. I think those areas will rather see inflows in that environment. But of course, there was a negative sentiment on the whole equity market. You saw massive outflows out of equity ETFs, I think even globally, also in the US, also Europe. So I don't think there's a massive change. Interestingly, where we hear most of the planned inflows is not China, is not the US, is really Europe, where I get a lot of questions from Asian investors, from US investors to say, okay, what is really changing there? It has been disappointing from a growth perspective, but there is the most questions. And I would expect inflows into the market once volatility is coming down, rather in Europe than in Asia or the US at this point in time.
Where in Europe would investors be investing in? Where's the most attractive opportunities you see in Europe?
Well, if we see some calming down of volatility, I would say it's first of all at the index levels, but then I would say probably you don't go to the major indices. If there's really a turning in Europe because of fiscal policy and some change in policy, I would even look not at the large caps, I would even look at the mid caps in Europe, which don't have this massive international exposure, but really are focused a bit more towards Europe. I think that could be quite interesting. We have not seen the performance yet, but I think there where investors will look at is really where you get core Europe and where there's some cyclical uptick. And I wouldn't rule that out that this is the case. So it's more mid-sized companies than the large-sized companies from my point of view. That's what I hear, what we also like from our perspective.
And realistically, what kind of returns do you think you'll see? If you take a look at the S&P, the last 2 years, we saw returns of in excess of 20%.
Yeah, I think we have already said at the beginning of this year, don't expect 3 years of 20% plus. That's really rare also in history, really rare. I'm not ruling out that we still come up with a positive year in equities in the S&P, so from that perspective, that's possible. Again, if you look at year-to-date performance, Europe, I don't want to always talk about Europe, but again, is rather positive at this point in time, even after the sell-off. So I would say probably get the best performance this year in Europe, can be followed by Asia, then followed by the US. It's a close call, I would say. It depends a lot on when we get solutions on the tariffs. I think if the solutions is far into Q3, not at the end of this 90 days, then it's unlikely to have a super nice positive performance. But if we get a positive single digit, I think that would be a very positive year.
Quite a reversal of fortunes for Europe, definitely there. Christian, thank you. Christian Nolting, Global CIO of Deutsche Bank. Well, still ahead this hour, the volatility seen in U.S. equities recently has managed to make Bitcoin look pretty well behaved. We hear exclusively from Coinbase Global Head of Institutional Sales on whether that's something she is selling to investors. Keep it here with us. This is Bloomberg. Welcome back. Here are some stories we are following. Intel agreed to sell a 51% stake in its programmable chips unit Altera to Silver Lake Management. The transaction values Altera at nearly $9 billion, which is about half of what Intel paid for it a decade ago. Intel CEO says the sale is part of a plan to spin off non-core assets and strengthen the balance sheet. Chinese battery giant CATL has reported a 33% jump in first quarter earnings, with net income reaching close to $2 billion. Revenue grew at just over 6% from a year earlier, defying a slowdown in EV demand. And LVMH sales fell more than expected in the first quarter due to weak demand for luxury goods in China and the US, and the threat of a trade war. Revenue at its largest unit, the fashion and leather goods division, dropped 5% from a year earlier. LVMH says it may consider increasing prices to help offset the impact of tariffs. And up next, we hear exclusively from Coinbase Global Head of Institutional Sales on whether gold's record rally is taking the shine off Bitcoin. Keep it here with us. This is Bloomberg.
China is the only country that actually implemented its retaliation and set it on this course. So obviously that's concerning, and the president has been very clear that he's willing to talk to his counterpart and that he expects that at some point we'll have talks. We're not there yet, but that's his expectation, and I share that expectation.
And that was U.S. Trade Representative Jamieson Greer speaking about the chances of a tariff deal with China. Meanwhile, Treasury Secretary Scott Bessent is hitting back after China's finance ministry called President Trump's 145% tariffs on the country a joke. In an exclusive interview, Bessent told us there could be a decoupling between the world's two largest economies. He also says he's committed to getting trade deals done with several other countries within 90 days.
I think now that we have the China tariffs in place, that they are going to want to have some protection from Chinese goods flooding their markets. That China's business model is like from that Disney movie where the brooms are carrying the buckets. Like they're not going to stop manufacturing because the U.S. has a tariff wall up, so those goods are going to go somewhere.
Where do you think they're going to dump?
Well, I think it depends on the good.
Well, we have exemptions now, though, for electronics, so we still expect electronics to come into the United States with the smaller tariff rate, the fentanyl, 20%.
But you were asking where are they going to dump. I think it will depend on what is the good. You know, higher value-added manufacturing goods, likely in Europe, Canada, in the G7, and then kind of more of the baubles and knickknacks in the global South.
China's Commerce Ministry came out when the tariff rates were going above 100% and called it, quote, a joke. Has there been negotiations on any level between Beijing and Washington right now?
Well, look, it'll come from the top. President Trump, Chairman Xi have a very good relationship. And I wouldn't say that these are not a joke. I mean, these are big numbers. I think no one thinks they're sustainable, wants them to remain here, but it's far from a joke.
Well, they just say that the rate is so high, it's become a joke. Basically, does it just stop trade between Washington and Beijing altogether? Do you see a decoupling of these two economies?
Well, maybe the trade minister has a different sense of humor I do, but I don't see anything funny about it.
Do you see a decoupling, though, between Washington and Beijing?
There doesn't have to be. There could be. There's a big deal to be done at some point, but look, what is different with China that is different in the history of trade, that normally, if you go back to the big trade deals or the currency deals in the 80s, the Plaza Accord, the Louvre Accord, the Reagan auto deals, our leading economic competitors were our military allies. China is both our biggest economic competitor and our biggest military rival. So that's going to require a special kind of formula.
Are you teasing out a Mar-a-Lago Accord that we should be paying attention for in the future?
I'm not sure what you're talking about.
Well, potentially getting all these trading partners together to discuss fair, balanced trade?
Well, we're doing that over the next 90 days.
Our exclusive there with Scott Bessent. Well, Japan coming back from lunch break. Let's take a look at how those assets are doing. We know that the topics and the Nikkei are in positive territory. Take a look at where the Nikkei is right now, up by about 1%. The same amount of gains for the topics as well, of course, on the back of some relief to do with pharmaceuticals. Now, Japanese yen currently trading 143.11 at this point in time, pretty flat versus the USD. The USD, though, currently pretty flat after 5 days of losses. It is the Japanese JGBs that we're concentrating on currently in terms of 10-year yield is pretty stable at 133.9. Now, in terms of the crypto market, let's take a look at how they're trading on the back of perhaps a risk-on sentiment today. It is joining that risk-on sentiment in Asia. Bitcoin trading up along with Ether and Solana. Of course, if you take a look at history has pointed that in terms of pressure from the economy, that has impacted the levels that we've seen in terms of cryptocurrencies. Well, staying with crypto, our next guest is responsible for developing and managing relationships with institutional clients at the biggest crypto exchange in the U.S. Joining us exclusively, Lauren Abendschein, Global Head of Institutional Sales at Coinbase. Lauren, good to have you with us.
Thank you for having me.
What are you making? How are you assessing the current environment for cryptocurrencies, given the trade tariffs that traders are mulling over.
Yes, well, it's certainly an interesting environment right now, a lot moving around. And Bitcoin, in some respects, has outperformed. But I think it's important to recognize that crypto, in many ways, has its own market dynamics and is maturing significantly as we see secular adoption for this technology and for this asset class.
Well, the thing is, in terms of risk-off, cryptos always get dented. It always takes a punch down. And I'm also wondering, when you take a look at history, when it is risk-off, when it is an environment where the economy is getting weighed on or is weakening, it's not good news.
Well, crypto is really a global story. And, as we think about what the impact can really be of this asset class in different market environments, I think what people sometimes miss is the fact that this is not just an asset class, but also a technology. And so when we see things like increasing usage of stable coins, when we see, increasing sort of utility and adoption here, I think that has an impact.
So what's the path forward?
Yeah, so I think an important path forward, an important sort of item to really think about here is in the U.S., regulatory clarity has brought a new dawn, or it's bringing a new dawn, for this asset class. We think about the stablecoin bill, market structure bill, and things like the SEC's crypto task force, really addressing some of the important regulatory clarity points that is essential for builders to be able to build, for investors to think about this asset class, and potentially for other regulators around the globe to see this as a race to the top. To bring some of that regulatory clarity forward.
You talk about regulatory clarity. People like Ray Dalio say that, the tariffs may cause a breakdown in monetary order. I'm just wondering, in such an environment, could crypto be the stabilizer? Could it be a haven play, in fact?
Well, a lot of people think that, and I think that's driving, a diverse interest in, Bitcoin in particular, but also crypto more broadly, recognizing that this can look like something like a digital gold, or a diversifier that has factors that really live outside of a lot of other asset classes. So I do think it's an interesting consideration when we see investors looking to Bitcoin and other crypto assets.
And speaking of gold, of course, gold has rallied. People expect gold to keep trending higher. Is that taking a bit of a shine off cryptocurrencies, you think?
I think the two, it's still early, for Bitcoin to really sort of have that correlation. And so, it's really, crypto in many ways has its own market dynamics.
Mm-hmm. Of course, the U.S. is a dominant market for you. Mm-hmm. How are you looking at investing in the rest of the region, here in Asia, for instance, on the back of Trump saying it wants the U.S. to be that crypto hub?
Right. Well, Singapore here in the region is our hub, and APAC represents an important part of our overall institutional and sort of global international expansion plans. And so we think that ultimately crypto is global. It's important for us to be able to operate in jurisdictions, globally, but also to see this technology broadly adopted. Our mission is to create economic freedom and bring that next billion people into crypto. And so that, by definition, means that we want to operate sort of internationally.
And expand.
Yes.
What's the strategy then?
Yeah. So for us, we want to look at where are we seeing regulatory clarity? Jurisdictions that want to be able to sort of welcome and open up new frameworks, whether that's for stable coins, whether that's for trading and other considerations. And so we're going to look to that clarity as well as commercial opportunity to drive forward.
So would that be markets like Singapore, Korea, where a lot of the retail investors are invested in cryptocurrencies?
Yeah. Well, and on that point, I think there is a lot of, across APAC, a lot of retail interest. And in many ways, that has been sort of the driver, of activity. But from my seat as an institutional, we see more institutional interest arising. And whether that's corporates thinking about, Bitcoin on the balance sheet or stable coins, whether that's banks and brokers recognizing that retail interest and saying, how can I offer that? How can I find a partner to really power my offering there?
As you said, your focus is institutional investors. I mean, talk to us about the kind of growth you've seen in terms of, pickup rate, and where are we seeing the strongest interest?
Right. Well, we certainly see demand for derivatives in the region, and that's driven, of course, our international exchange, perpetuals exchange, and addressing that that need and interest. So there's that active trader community on the institutional side. But again, we also see, banks, brokers saying, I'm hearing from, high net worths, I'm hearing from family offices that they want access to Bitcoin in this time of uncertainty. How can I offer that? And as well, again, as corporates who are thinking, stable coins represent this new opportunity to be able to affect near instant, near free transfers. How can we adopt this technology?
Is it possible to possibly draw this distinction in terms of demand in Asia versus the US and Europe?
Yeah, absolutely. We do see differences, in terms of maturation of markets. For example, US ETFs, really took off, and that's been an important market for us from a custody perspective. And so we do see different regional dynamics for sure. Again, here in APAC, we see more of that retail, active trader, opportunity, and sort of diversity across each of these markets in terms of participation.
But this is all happening at a time when there's so much uncertainty. Are investors holding off in terms of investment? And is Coinbase also, in a sense, holding off its investments, waiting for greater clarity in terms of policies?
Well, we do see adoption of this technology in a time of uncertainty, right? Because crypto represents new opportunities. It can provide new opportunities to again, think about reducing costs, to think about ways for bringing sort of investors into the space to engage on topics like tokenization. And so because this is both a technology and an asset class, it does present that sort of new set of opportunities.
And we're also expecting more crypto companies to IPO in the US. How are you looking at this, including the likes of Circle, where you have a stake in?
I think the crypto, the IPO market sort of remains to be seen. But again, having regulatory clarity is something that I think is important for any builder in the space, any company in the space. And so from the perspective of, furthering the industry, I think that's key.
Lauren, thank you so much for dropping by.
Yes, thank you very much.
Lauren Abendschein, Global Head of Institutional Sales at Coinbase. Well, U.S. Treasury Secretary Scott Bessent speaking exclusively with Anne-Marie Horton earlier on at Buenos Aires. We'll bring you some of the details later on. Still to come, we'll discuss what to watch when markets open in India as traders return from a holiday, and President Trump considers a temporary tariff reprieve for autos. Keep it here with us. This is Bloomberg. You're watching Insight. As President Trump looks to reorder global trade, investors are looking to economies that will first be in line for tariff negotiations. Indian stocks have managed to avoid the worst of the sell-off in the past week, and April has been tracking this. April, Indian stock market back from a holiday. How are they starting the trading session?
They are looking pretty upbeat, Has. I mean, we were already expecting some form of catch-up, but also look at how we're faring at the start of trade. The idea that when it comes to some of these trade talks with the U.S., that India could be among those first in line. Sources telling Bloomberg that they are set to begin talks this week, virtual talks, with an aim to getting some clarity on what sectors could be open or eligible for concessions by the end of May. So that would be welcome news for investors. Indeed, you're seeing the reaction in markets. But aside from that, keeping a close watch on pharma stocks along with some of the auto-related stocks. Remember, we are hearing that Trump could be giving reprieve for autos, but for drugs, pharmaceuticals, maybe pushing ahead with tariffs. Keep in mind as well, one key consideration and a pillar of support for India's stock markets in the form of mutual fund flows. Data out last week showed us how that actually has slowed. So keep that in mind, even as we see the gains in India's markets today. Flip the board and take a look at how India bonds are faring. They, too, have been kind of bucking the trend of global selling. And today, we're seeing them extending gains. And this is perhaps also getting support from the RBI announcing this week fresh open market operations to inject liquidity into the system. Looking at the rupee as well, back from a holiday, and it is firming up, Haas.
Right, Avril Hong, thank you so much for that. Now, with President Trump's so-called reciprocal tariffs still very much up in the air, global investors are refocusing on Indian assets as a relative safe haven. An MSCI gauge of India stocks has dipped less than 3% since April 2nd, about half the decline in a measure of Asian peers. Asia equities reporter Chiranjeevi Chakraborty joins us from Mumbai. What makes India stand out, CJ?
Well, I think for starters, it's the domestic, nature of the economy that has investors sort of seeing this country as a haven at this point of time. Remember that Indian exports as a percentage of U.S. imports is very, very minuscule compared to, the larger trading partners of U.S. like China or European Union. So therefore, investors feel that probably the impact of the, the global reordering of the trade channels will not have as much impact on India as was feared earlier.
So retail investors supporting the markets. How about overseas fund managers? What are they saying?
Well, the sound bites coming from them is pretty solid at this point of time. Some are thinking that India could be in a position to relatively outperform even the Asian peers going ahead. Others are, looking for opportunities already during the market correction that we have seen since the tariff announcements back on April 2nd. But overall, if you look at the fund flows, they are still quite negative for the month and for the year so far. So there is still quite a long way to go as far as foreign investors are concerned in terms of turning net purchasers of local stocks.
That's right. We saw how there was a rotation from India to China as well not too long ago. What are the risks to the view? I mean, where do we go from here?
Well, the risks are obviously, on the earnings front. Let's not forget that India had been correcting almost 6 months in advance, compared to the U.S. market or some of the other global peers because of the slowdown in earnings and the economy. There is now hope that the economy will perk up later this year with government spending picking up and, the Reserve Bank of India also boosting liquidity as well as cutting interest rates. Now, we have to wait and see what corporates say as they, announce their fourth quarter, fiscal quarter earnings in the coming weeks and days ahead, and that commentary could pave the way for how analysts look at earnings growth going forward. So far, the expectations are quite conservative, but let's see if the commentary is on the upside, then that could be a real sort of booster for Indian stocks going ahead.
Monthly flows of $3 billion. CJ, thank you so much for that. CG, of course, Bloomberg Asia equities reporter. Now, another big emerging market grappling with the tariff uncertainty is South Korea. The country's leading cosmetics maker says it's discussing contingency plans and possible price rises as it assesses the impact of Trump's tariffs. Bloomberg's Asia trade co-anchor Sherry Yan spoke exclusively to Amore Pacific CEO Seung-Hwan Kim.
Our North America business is our core region. So obviously we've been following the situation closely, and we're looking at the strategies that we need to have in place. But we also need to be concerned about how our actual customers in the U.S. are going to react to this tariff increase. And we need to look at the policies of the resellers that we're working with, so we're in discussions with them now to see how we can respond.
Are you even considering perhaps having to raise prices?
First of all, there is a cost increase factor, so there is a price increase factor. But this is a common problem not only for us, but for all beauty companies around the world. Also, since we are working with major retailers rather than doing business ourselves, we need to keep pace with them. So we are talking very closely.
You manufacture mostly in Korea, also in China. Do you plan to perhaps invest more in the U.S. and start production there?
Right now, we're primarily doing business through our manufacturing facilities in Korea and China, but with the rate of growth of our North American businesses, we're looking positively at the long term and preparing for manufacturing facilities that we need in the U.S. as well.
Do you have a time frame in mind?
3에서 5년 정도는
I'm thinking for the next 3 to 5 years about investments from a logistics perspective that could make the current U.S. business a little bit smoother, or some modular production of products. For the actual production facility, we're thinking about 5 to 10 years, but with the recent changes and trends, I'm thinking that maybe we need to step it up a little bit.
How are you playing the different price points when it comes to the Chinese market? Because I know that you've also tried to increase your premium branding over there.
말씀하신 대로 중국에서는
In China, we have been operating in the affordable to luxury segments.
The local brands in China have recently become very competitive. So in the long run, we're going to focus much more on the premium and luxury segment with brands like Sulwhasoo and Laneige.
We'll be focusing a little bit more on the luxury premium tier in China. In the U.S., we have that tier, but we still have more opportunities in the affordable price segment. So in that sense, I think the strategy might be a little bit different. In terms of the beauty market in China, it's true that it has slowed down a little bit in the last couple of years. I think it's probably a short-term impact, but it's such a big market, and there's so many different on-demand deals, and I think it will rebound at some point in the long term. It's true that our business in China has actually been a little bit challenging in the last couple of years, and that's why we've been doing a lot of things in the last 2 to 3 years. We've done some proactive restructuring in the last 2 years in changing the deal structure, making our pricing and distribution much cleaner, shifting our channels from offline to online. So we've seen a dramatic improvement in the profitability of our China business since the second half of last year, and we think that we're now on a track to normalization. We're going to invest in China to make sure that we have a much healthier and sound growth going forward.
What markets have the most potential at this point for Amora Pacific?
At our current growth rate, North America, Europe, and Japan are the markets that we will focus on over the next 3 to 5 years. And then from a long-term perspective, we're looking at India, which is not a very big market yet, but it's growing at a very fast pace. And then we're looking at the next growth market, which is the Middle East.
Amora Pacific CEO Seong-Won Kim. Now, here are some of the stories we are following. Goldman Sachs stock traders have posted their highest quarterly revenue haul on record, riding a wave of trade war volatility. Equity trading revenue rose 27% from a year earlier to almost $4.2 billion. Top-line revenue topped $15 billion, the third best quarter on record.
Markets will likely continue to be volatile until we have further clarity. The administration's focus on trade barriers and strengthening the U.S. competitive position is commendable. At the same time, it is important to recognize that few companies have benefited more from a post-World War II economic and financial order than the U.S.
Apple's iPhone shipments reportedly surged 10% in the first quarter. Industry tracker IDC says almost 58 million units were delivered through March, up more than 5 million from the same period last year. The tech giant is accelerating deliveries as it works to limit the impact of tariffs on China. And Apple will begin analyzing data on customers' devices in a bid to improve its struggling artificial intelligence platform. The company says it will use actual emails to cross-check with the synthetic data used to train its AI model. In a bid to allay privacy concerns, the company says user data will remain on customers' devices. In Asia, pretty much risk on. We're seeing Sensex in particular extending those gains, currently up by more than 2%. Gains too for the likes of Taiwan, Indonesia, as well as South Korea. We're keeping an eye on the Indian rupee right now, up by 0.4%. Gains for the rest of the Asian AFEX. We have the dollar stable at this point in time, though, coming off 5 days of losses. In terms of the yen, that is one currency we are tracking. Of course, a stronger currency would have ramifications for exporters in particular. Of course, the Nikkei 225 in positive territory on the back of perhaps a pause in those tariffs for autos. And this is how it's looking for futures in the U.S. S&P, pretty flat. And we have losses for the Nasdaq 100 futures, currently down by about 0.1%. Before we go, here's a look at tomorrow's show. We'll have fresh market analysis with Morgan Stanley Investment Management's Andrew Sliman. Keep it here with us. This is Bloomberg.